The weak risk stopped being fashionable. It didn't happen after a crash. It didn't happen after a warning. It happened when risk quietly went out of style, replaced not by fear, but by discomfort. To understand why this moment matters, we need to return to a period when taking risk was still celebrated. Markets rewarded boldness. Exposure was framed as confidence. The willingness to lean in was seen as intelligence, not recklessness. For a long time, that mindset worked. But markets don't change when risk fails. They change when risk becomes crowded. The first reveal begins with language. Subtle shifts in how professionals spoke about opportunity. Conversations move from how much upside remains to how much downside is tolerable. Not dramatically, casually, almost unconsciously. Risk was no longer exciting. It was something to be managed quietly. The second reveal appeared in allocation behavior. Funds didn't rush to de-risk. They adjusted. Exposure stayed on, but with tighter controls. Positions were structured to exit faster. Liquidity mattered more than conviction. Risk wasn't abandoned. It was treated with suspicion. The third reveal came through what stopped working. Strategies built on momentum lost consistency. Trades that relied on aggressive follow-through stalled. Moves extended less often. Gains required more explanation. Taking risk no longer felt effortless. That was the weak risk stopped being fashionable. Not because something broke, but because something shifted. When risk becomes ubiquitous, it loses its edge. And when it loses its edge, the smartest participants don't announce a retreat. They quietly change their posture. What followed would show how quickly markets respond when risk is no longer admired, but merely tolerated. As that posture changed, the market didn't react immediately. Prices still moved. Opportunities still appeared. But the enthusiasm that once powered those moves began to thin. Risk-taking hadn't disappeared. It had lost its status. What was once praised now required justification. The conflict emerged in how trades were evaluated. Winning positions were no longer celebrated automatically. They were questioned. How liquid is this? How quickly can we exit? What happens if conditions change tomorrow instead of next quarter? These questions didn't kill risk, but they slowed it down. Institutional desks felt the shift first. Approval processes tightened informally, not through new rules, but through tone. Aggressive ideas faced more scrutiny. Conservative structures gained quiet favor. Exposure was still allowed, but only if it came with an escape plan. Risk had become conditional. The tension deepened as this mindset spread. When fewer participants are willing to lean in confidently, price discovery changes. Moves take longer to build. Pullbacks don't attract immediate buyers. Breakouts feel hesitant. The market begins negotiating with itself instead of committing. Derivatives markets reflected the change clearly. Demand for protection rose even as volatility stayed calm. Skew adjusted in ways that suggested discomfort rather than fear. Traders weren't betting on collapse. They were hedging embarrassment, the risk of being wrong at the wrong time. The buildup accelerated when performance dispersion increased. Some strategies still worked, but unpredictably, consistency faded. Risk no longer paid reliably. That uncertainty made taking risk feel unfashionable. Why lean in when the reward felt random and the exit uncertain? Language shifted further. Meetings focused on resilience instead of return, on optionality instead of optimization. These weren't defensive conversations. They were adaptive ones. The market was teaching its participants something without ever saying it aloud. The most important change was psychological. Risk stopped feeling like a badge of confidence and started feeling like exposure to regret. And regret is powerful. It reshapes behavior faster than losses ever could. As the week progressed, this new attitude solidified, not through headlines, through repetition. Each session reinforced the same lesson. Acting boldly no longer felt rewarded. Acting carefully felt smart. The market hadn't rejected risk outright. It had demoted it. And once risk loses its prestige, participation changes in ways that no indicator can measure. The system still functioned, but it no longer celebrated the behavior that once kept it moving. That quiet demotion would soon matter far more than anyone expected. The consequences of that demotion surfaced gradually, but unmistakably. As risk lost its appeal, Participation thinned at critical moments. Not everywhere, not all at once, but precisely where conviction once mattered most. Moves began, then stalled. Momentum faltered without explanation. The market no longer rewarded bravery, it punished impatience. The conflict intensified when stress tested this new psychology. A routine pullback appeared, the kind that once invited aggressive buying. This time, bids arrived cautiously. Size was smaller. Timing was delayed. Buyers wanted confirmation before committing, and confirmation never quite arrived. What followed wasn't panic, but drift. Institutional strategies adjusted defensively. Risk limits weren't breached, yet exposure was reduced incrementally. Stop losses tightened. Time horizons shortened. These changes weren't reactions to loss. They were reactions to discomfort. Risk no longer felt worth defending aggressively. The buildup accelerated as correlations began to tighten. Assets that usually offset each other moved together, not sharply, but persistently. Diversification weakened quietly. When risk is unfashionable, protection becomes popular. And when everyone seeks protection at the same time, markets lose their natural shock absorbers. Derivatives markets confirm the shift. Hedging demand increased during calm periods, not volatile ones. Traders weren't responding to fear. They were responding to uncertainty about participation. The question wasn't what if prices fall? It was, who will step in if they do? Veteran participants recognize the warning signs immediately. Markets don't need fear to destabilize. They need reluctance. When risk is tolerated but not embraced, liquidity becomes conditional. And conditional liquidity disappears exactly when it's needed most. The tension peaked when a slightly larger move tested the system. Nothing historic, nothing dramatic. Yet the response was uneven. Support arrived late. Recoveries felt forced. What once felt automatic now required effort. The market revealed it no longer trusted risk-taking to be rewarded. At that moment, the demotion of risk became structural. It wasn't just sentiment, it was behavior. Risk had lost its social proof. No one wanted to be seen leaning in first. And when no one wants to lead, markets hesitate. The system still stood, but it stood without enthusiasm. And enthusiasm, once gone, doesn't return quickly, because markets don't thrive on caution alone. They move when belief makes action feel safe. That belief was fading, and the final phase would show what happens when a market built on participation learns to survive on reluctance instead. The moment of truth arrived not as a collapse, but as a confirmation. A broader move unfolded, steady and persistent, revealing how deeply the market's attitude toward risk had changed. Prices moved without urgency, yet they moved decisively enough to force alignment. Risk wasn't rejected in panic. It was sidelined through indifference. That was the climax. The market didn't punish those who avoided risk. It rewarded them. Positions built on caution outperformed. Flexible capital preserved value. Strategies designed for restraint navigated the shift with ease. Meanwhile, approaches that depended on enthusiasm struggled, not because they were wrong, but because the environment no longer supported them. What became clear was unsettling. Risk hadn't disappeared. It had become asymmetrical. Upside still existed, but it required precision. Downside demanded patience. The easy rewards of bold exposure were gone. Risk, once fashionable, now required justification at every step. As conditions stabilized, the resolution unfolded quietly. Participants adapted. New norms formed. Meetings emphasized resilience over ambition, optionality over conviction. The market found balance again, but it was a different balance, shaped by caution rather than confidence. The deeper lesson lingered beneath the surface. Markets don't change only when losses occur. They change when behavior is re-ranked, when certain actions stop being admired and start being questioned, when the social proof that fuels participation quietly evaporates. Risk didn't fail that week. It fell out of favor. And in markets, favor matters more than logic, because once risk stops being celebrated, it stops being supplied freely. Liquidity becomes selective. Participation becomes conditional. And every move carries more weight than before. The weak risk stopped being fashionable, wasn't remembered as an event. It was remembered as a feeling, a shift in tone, A quiet understanding that the rules of engagement had changed. And once that understanding settles in, markets never return to the way they were before. So what do you think? What behaviors are we still rewarding today that might quietly fall out of favor tomorrow? The week